Hello, this is Dean Malone with Compass FX. I hope you're doing well today and you're getting some good trades. In my video series about reading the charts, I want to discuss how to identify and trade the bullish flag chart pattern. This is one of those patterns that has oftentimes an above average expectation because it completes more times than not when you identify a real bullish flag pattern. Let's take a look. A bullish flag is formed during a market correction in an uptrend. Oftentimes retail traders will see this as a potential reversal, but it's not. We look for some specific setups that will let us know that the market's going to continue instead of being a reversal. Lower highs and lower lows create two parallel lines known as the flag that slope counter to the uptrend. So if you'll notice here, you have the lower highs and you have the lower lows, and this forms the flag. Generally speaking, the flag consists of 4 to 8 candles. When you start to go beyond that and have 13 to 20 candles that are potentially in a flag, there's the potential that the market will continue going sideways. What we look for is the pattern to be completed by a break outside the parallel lines. We're looking for the market to continue making its move in the uptrend, and we look to enter the market on a break of the flag in this area. The name bullish flag is derived from the previous uptrend forming the flagpole of the flag pattern. So as we can see here, we've been in this uptrend, we reach a high of the flag, and then we get this pullback or this correction in the marketplace. Now oftentimes this correction is due to profit taking by many market participants. Take some off the table and then look for continuation. For those of you who use Fibonacci retracements, if the flag is only a retracement of about 23.6 to 38.2, and that's as far as the market goes, then there's a high probability that the market's going to continue pushing higher. Now how do we go about trading the bullish flag? Well, the first step is to take a measured move. A measured move is the distance from the low price of the flag to the high price of the flag. And we're going to use this measured move as a potential target when we break outside the flag. So we enter on the break of the flag. So when the market starts to break the flag, or once the market has closed outside the flag, it's dependent upon your style of trading. You can trade as we break or wait for the candle to close and then the next candle open up and enter there. But you're looking for this break of the flag. The next thing we want to do after entry is to identify both the targets and the initial stop loss. There are two specific targets. First is the top of the flag, or the high price of the flag based upon the measured move. If you'll notice here, we're entering the market a little bit below the top of the flag. So this will be one target to this point. But what we'll do is at the break, we'll take this measured move and we'll stack it right on top of our break, or right at the entry point, and look for the market to make that move, and our target is going to be up near that high point. The other thing we want to do is to look for our initial stop loss, and that's simply taking the measured move, reversing it in the opposite direction, and we look for if the market's going to move back, and this will be a double top pattern instead of a bullish flag pattern. This will be our initial stop loss, and we may look for a stop and reverse technique if the market's showing a double top type pattern. Now in the event that the market makes its move up and goes beyond that second target of ours, which is the measured move, there's about 3 different things you can do to stay in the trade and to look for additional targets. That would be Fibonacci extension, pivot level, or by stacking another measured move. Simply taking this original distance and stacking it on top of the previous measured move that we had. Now let's take a look in the marketplace at a bullish flag. I found the EURUSD 1 hour chart having a bullish flag within an uptrend pattern. Can you see it? By placing trend lines on the chart, you can see the flagpole, you can see the lower highs, and you can see the lower lows. And notice that the lower highs and lower lows are forming this parallel look of these two lines. So we're going to be looking to enter right about this area on the break of the flag. Now, before we look to enter on the market, again, we're going to take that measured move from the high price of the flag to the low price of the flag. When the market makes its break and we enter, then we'll take that measured move, we stack it on top, and you can see that the market did move up to that level before coming back down. Again, from a proper money management standpoint, we want to look at our initial stop loss, and we simply take that measured move from our entry point, reverse it, and that would be where our initial stop loss is. So this is the way to identify and trade a bullish flag pattern. Well, folks, this is D. Malone with Compass FX. I hope some of this information will help you in your trading. Y'all make it a good day. Get some good trades. We'll talk to you next time. Bye-bye.